Good evening. Tonight we will be presenting the results of our financial analysis of Kroger Company and Whole Foods Market. Both companies have a market capitalization between 15 and 20 billion, which makes this an ideal comparison within the grocery industry.
So who are the shareholders? Both Kroger and Whole Foods Markets are popularly traded stock. Kroger currently stands at 372.51 million shares outstanding. The top 10 institutional investors make up almost 32% of these shares outstanding. Meanwhile, Whole Foods stands at 533 million shares outstanding, with the top 10 institutional investors making up all over 40% of those shares. Vanguard Group and State Street Corp both cracked the top 5 of institutional investors for each company.
Investors are highly concerned about the company's cost of capital. When considering any investment, a potential investor will look for firms that are maximizing total value or are taking steps to maximize it in the future. Finding an optimal cost of capital allows a company to do just that. The higher the firm value, the higher the potential returns for the shareholder. Investors are also interested in the overall capital structure of the company. If a company is leveraged too greatly by debt, it puts the shareholders in an elevated position of risk. On the other hand, if a company is leveraged too greatly by equity, it could mean that the company is not aggressively using its capital and therefore is not maximizing the firm's value. One part of a company's capital structure is the cost of debt financing. The cost of debt is the effective rate a company pays on its current debt. This rate can be measured in one of two ways: pre-tax and after-tax. Since interest expense is deductible, the after-tax cost of debt is the form most commonly seen. To calculate the pre-tax cost of debt, the risk-free rate of each company must be added to its corresponding default spread. Since Kroger and Whole Foods both have a BBB bond rating, the pre-tax cost of debt for each company is 3.78%.
The cost of equity financing can be calculated using the capital asset pricing model. Under this model, the current risk-free rate is added to the company's beta, which is first multiplied to the difference of the market risk minus the risk-free rate. In order to calculate beta, we ran a regression analysis of each company's stock returns for the past 5 years and compared that against the market returns. To provide a sample for the market, we used the market returns for the S&P 500. The S&P 500 is a good index to use because it provides an idea of the overall movement of the U.S. equity market. In the example shown below, the regression analysis provides us with a beta of 0.41, which we were able to use to determine a cost of equity of 2.73%. The cost of capital is the required rate of return necessary to make a capital budgeting project. The overall cost includes a component of debt and a component of equity. If Kroger or Whole Foods Market plan to build a new retail location in the future, they would run an analysis of the current cost of capital. This would provide an idea of the best method in order to raise funds for the desired capital project. The overall cost of capital is calculated using a weighted average method, known as the weighted average cost of capital. This method weights each component of a company's capital structure and weights it proportionally. Therefore, if a company's capital structure is comprised of more debt than equity, the overall cost of capital will reflect that and more closely mirror the cost of debt. Currently, the weighted average cost of capital for Kroger is 2.65% and 2.78% for Whole Foods. The cost of capital can be manipulated lower by adjusting the amount of debt a company carries. By changing the current debt ratio of each company to the optimal level of 0%, we can see many factors change. The cost of equity is now lower than before. You will also notice that the bond rating for each company has improved significantly, going from a BBB rating to a AAA rating. Firm value has increased by over $1 billion for each company, and the value per share has also increased by as much as $5 for Whole Foods Market.
The results presented in this analysis suggest that Whole Foods Market should reduce its current debt-to-equity ratio from 22.07% to 0%. This reduction would increase Whole Foods Market's firm value from the current $23.4 billion to the optimal value of $24.8 billion on a perpetual growth basis. The net gain in Whole Foods Market's firm value in this analysis would total $1.3 billion. Kroger would also benefit by reducing its debt to 0%, which would increase its value from the current $21.3 billion to the optimal value of $22.4 billion. Currently, Whole Foods Market's debt ratio and Kroger's debt ratio are higher than the optimal debt ratio. Although we can see the benefits of decreasing their debt to the optimal level in terms of firm value, a debt level of 0 is not a desirable goal. For example, Whole Foods Market leases most of its stores in order to retain flexibility. However, an increased debt level might affect the credit ratings of both companies. Their current BBB bond rating might be downgraded, which leads to a higher cost of debt and therefore a greater cost of capital.
Two industry competitors of Kroger and Whole Foods Market with relatively comparable market caps are Costco and Target. Looking at the asset makeup of the companies, we notice that Kroger, Whole Foods, and Target all have similar percentages of long-term assets. However, long-term assets only make up about 50% of Costco's total assets. This is due to a higher percentage of cash on hand, with nearly 3 times as much cash as the other 3 companies combined. As we look at the liabilities and equity, one company stands out from the group. Whole Food Market shareholder equity accounts for a whopping 71.8% of its total liabilities and equity. The answer for this discrepancy can be found by looking at the long-term liabilities. Whole Foods' long-term liabilities are only a small fraction of those listed by the other 3 companies. It speaks to the small amount of debt held by Whole Foods. In fact, its only debt is related to capital leases for its retail locations. When we compare the closing stock prices for the end of the fiscal year 2012 to the stock prices derived from this analysis, we see that both companies are undervalued. Kroger had a closing stock price of $27.70, while our analysis prices Kroger at $30.04, an increase of $2.34. Whole Foods Market had a closing stock price of $47.34, while our analysis prices it at $52.33, an increase of $5. When we take into account the increase in share price and the increase in the overall firm value, we see that Whole Foods Market presents the better investment at this time.